Hello everyone. In this video, we'll be starting with the chapter number. Just a second. We'll be starting with the chapter number 9, and that is volume and breadth. Before watching this video, make sure that you check the previous chapters out. In case you haven't, then I've linked it in the description box below. In this chapter, we'll be talking about various sorts of volume indicators like the on balance volume, accumulation distribution, and VWAP. We'll also see that how do you analyze the changes in breadth in context of the price trend, and we'll be seeing various sorts of breadth indicators as well. Let's start with what are volume indicators. So volume indicators basically talk about how to use volume, and we're going to see how we can use volume in our trades. Stocks as well as the futures markets, both of these markets have a lot of volume indicators and they help us making our calculations more robust. The following sections gives the most popular indicators, most of which originate in the stock markets. Okay, let's begin with this. First of all, let's understand why do we need to see volume indicators? Why do we even have to take into account volume indicators when we are taking a trade? So, volume indicators basically signify how strong the trend is, and it helps us to exit our positions when the volume is declining, and it helps us to enter a position, and it gives us more confluence and more confirmation that the trend is going to go in our direction. So first, let's see what is average volume. The most basic of all volume indicators is the average, and the calculation most commonly used for the equity markets is 50 days, although it may be reasonable to use the same period as the price average that is being used. So whatever moving average you are using, make sure that the average volume indicator is also set to the period of the moving average. So whatever range you are keeping for price indicators, you need to keep the same range for the volume indicators as well. So let's say if you are using the 200-day moving average, then you need to use 200-day volume only. And anything which is less than 50 days is not likely to be smooth. So make sure that whatever you're using should be 50 days or more than that. Okay, so now let's see normalizing the volume. Normalizing, you know what normalizing is? First standard deviation. It is always convenient to normalize prices to view them compared to the recent average. This can be done for volume. Letting the calculation period n be either 50 or 200 days, we can normalize the volume and represent the result as a percentage. So what is the normal volume? Percentage, always it should be multiplied by 100, multiplied by Vt, which is the volume, divided by summation of T minus P plus 1, Vt divided by N. So whatever the value is that you are going to divide by N. Just keep that in mind. What you're going to do is 100, because you need it in percentage, multiplied by the volume, divided by the summation of volume, multiplied by N. The normalized volume lets us say that today's volume is 20% higher than the volume over the past 200 days. So that's the way you're going to depict it. Volume, momentum, and percentage change. Two other basic volume indicators are momentum and rate of change. These techniques we have anyway seen earlier, but let's see them again. So if you look at these, you can see that this is the price of the Microsoft chart, the first table, normal price in the bar charts. And then we have volume over here. These are regular bars. You can see it, regular volume bars. And then this is the normalized 50-day volume. This is the volume. And the third one is basically volume oscillator from ratio, and it is based on 14 and 34-day period. So for momentum, this means finding the change in volume over a specific interval of time. That means percentage change measures the size of the volume change related to the starting value. If T is today, then N is the number of days back. So how do you find volume? Momentum, volume of today minus the volume which it was that day, which is T, today's volume minus that day's, right? T minus N would give you the day on which you are starting the period. If let's say it's going to be, you want to find the volume of today with respect to the 200-day volume, then that's going to be volume momentum is equal to volume of today minus volume of what it was on today minus 200. That would give you the day which was 200 days before. Okay, and similarly, if you want the same thing in percentage, If you want it in the rate of change, then you are just going to divide it with the second value, which is what it was 200 days before. Okay. There is a high variance of volume from day to day, and volume momentum tends to increase the erratic pattern. It will be necessary to smooth the volume momentum in order to have a useful indicator. Let's start with the first thing, which is known as force index. Let me see if it is available on the trading view. Force indicator. Okay, there is force index over here. I'm not able to plot it. Okay, let me just go on a bank or any random stock. Okay, now it's being plotted. So this is known as the force indicator. Look at this. There's a zero line in the middle. The dotted line in the middle is a zero line. And let's see how it's going. Here, okay, this is how it looks. First, let's read the information and then I'll come back to this. So Alex Elder was the person who devised the force index. The force index is the change in price multiplied by the daily volume. So price, the change in the price multiplied by the daily volume will give you the force index. Now you need to keep this formula in mind. Closing of today minus close of the yesterday multiplied by volume. So again, think about it. Force index is the change in the price. When I say change in the price, I'm obviously talking about today. So that's going to be today's price minus yesterday's price multiplied by volume, and that is going to give me my force index. The force index will be positive or negative if the price change was higher or lower. It is also not limited to daily charts, but it can be applied to weekly or monthly data, as can many of the methods in this chapter. Again, what is the formula of force index? Closing of today minus closing of yesterday multiplied by the volume. The price change multiplied by the volume will give the force index. Okay. Once the daily force index is calculated, it should be smoothed. Now, why are we smoothing these indicators? We are smoothing it so that we have less of whipsaws and we have a clear understanding and we avoid the noise which is there. For timing entries and exits, it is suggested that the 2-day exponential moving averages with a smoothing constant of 0.667 be used to avoid unnecessary noise in the indicator. Again, 2-day moving average is used with a smoothing constant of 0.667. So when you do that, then the noise is basically not there anymore. For longer term analysis, a 13-day EMA with 0.14 should be used. For short term, you are just using a smoothing constant of 0.667. So like we have also seen in the other chapters, usually the smoothing constant which we are using for a short term case is usually 0.667, and whenever we are doing a longer term analysis and you are using a smoothing constant of 0.1428. Consistent with the idea of noise, the 2-day smoothed moving average buys when the value is low and sells short when it's high. However, a 13-day value is treated as a trend, giving a buy signal when it crosses above 0 and okay. Let's quickly understand what they're trying to say. When you have a 2-day smooth when you have a when you have a 2-day smoothed force index, you are going to buy when the value is low and you are going to sell when the value is high. Moving on, we are going to talk about what is a volume oscillator. Now, visualizing the pattern of volume can be very helpful, and it is the simplest way, that is the volume oscillator. I'll show you what a volume oscillator looks like. Okay, this is a volume oscillator. I'll remove EFI now. Okay, this is how a volume oscillator looks like. There is a zero line in the middle and different pointers are being plotted using the volume oscillator. Now, this basically addresses the issue of the erratic data by two smoothed values, and it uses just one smoothed value. Now let's look at what it does. A volume oscillator is a two-step process, and a 14-day period and a 34-day period are used. So whenever you're talking about a volume oscillator, you are using a 14-day period as well as a 34-day period. So what is the first method? Calculate the difference between a short-term and a long-term average of volume using 14 and 34. So how do you calculate the difference? We have summation. Just a second, let me zoom in. Okay, yeah. We have summation I is equal to T today minus 14 plus 1 volume divided by 14, and you're going to minus the T volume. Okay, volume, the formula in simple terms, don't get confused looking at this, I'll quickly explain that. Volume of now divided by 14 minus volume of now divided by 34 is the difference which you'll use in the first method of volume oscillator. Now, summation is t minus 14 plus 1, and in this case it is t minus 34 because you are using a 34 period plus 1. Okay. Then we have, so the first and foremost method is to calculate the difference between the two period moving averages, which in this case was 14 and 34. Now you are going to calculate the ratio of a short term and a long term sum volume, again using 34 days. So whatever you found out, the V1 divided by V2 will give you the ratio. The first thing you are doing is calculating the difference, and the second thing you are going to do is basically putting it down in a ratio. Once it is calculated, once calculated, the oscillator values can be displayed as a histogram or a line chart. Line chart is what we were seeing until now. Now let's see figure 9.1. I think it's above. Yeah. So look at this. This is a figure 9.1, and you can see that the third indicator which is plotted, this basically is a volume oscillator which is plotted using the ratios. Hmm. Microsoft from November 2010 to April 2011, volume in the second panel, the normalized 50-day volume in the third panel. The volume oscillator using the ratio at the bottom. In this example, the volume oscillator does not confirm the upwards or downward trends. Perhaps that is the correct interpretation because the trends were short-lived. Now let's see what they're saying. If you look at this, nowhere did there was no volume spike anywhere, right? There was nowhere which said that you need to buy, and you can see that all the trends were short-lived, so the volume gives a good sign of not entering into the market itself. So that is volume oscillator. Now let's see what is an OBV, which is a non-balanced volume. I'll plot that and show as well. On balance volume. One sec. Okay. So again, on balance volume also looks very similar to the volume oscillator, but there is a difference in the calculation of the same. Let's see that, and let's see what's the whole point of OBV. OBV is now a byword in a stock analyst circles. On days when the price close higher, it is assumed that all volume represents the buyers. On lower days, the volume is controlled by the sellers. So looking at the chart, you can analyze what the volume is showing. Is the volume talking about higher buying, or is the volume talking about higher selling? Now that is again given according to the closing. You are going to see the closing price. So what they're saying is, let's say right now, if you're looking at the last candle, it is a green candle, right? So if you're going to see the volume below corresponding to it, you will assume that it is showing you the volume of the buying because the candle was a buying candle. Whereas if you see the previous candle, that is a black candle or a red candle, so if you see the volume which is corresponding to it, you can see that that is also representing the selling pressure. So whatever color the candle is, that means whatever happened throughout the day, you can assume that the volume is only talking about that. Okay. The volume is then added or subtracted from a cumulative ratio OBV. If today's price change, let's say today's price, okay, what is this? Don't get confused when you look at these mathematical terms. Just think about it. T means today, P means price. So in the case when today's price is more than yesterday's price, then OBV will be OBV of yesterday plus today's volume. OBV of yesterday plus today's volume. If today's price is less than yesterday's price, then OBV will be today's OBV minus of today's volume. Sorry, yesterday's OBV. Okay, again, let me just quickly revise the formulas. Don't get confused. Just try to make notes along with me. Okay. If today's price is more than yesterday's price, then our OBV is going to be yesterday's OBV plus today's volume. If today's price is less than yesterday's price, then OBV is going to be yesterday's OBV minus of today's volume. Very simple. The result is a volume weighted series which serves to smooth out the erratic nature of the data. In the following formula, the expression in parentheses simply uses the closing prices to produce the value of plus 1, 0, and minus 1. Let's look at the formula. This is the weighted volume series. OBV is going to be yesterday's OBV plus today's close minus yesterday's close divided by today's close minus yesterday's close multiplied by volume. Now you will assume that this is just a division between the two and it's going to become 0. But that's not the case because here you are taking a modulus. This is a modulus and this is not a bracket where you can just cut. So if the value is negative, then you need to see, right? So that's how it is being used. Determining the OBV manually is a simple accumulation process shown in table 9.1. Let's see the table 9.1. Okay, so this is the table 9.1. So we have closing price, we have daily volume, and we have on balance volume. On balance volume is 0. Here it is 30. Here it is 57. Okay. Now why, from where did they get this particular values? If you think about it, then just go and put it in this formula, then you will get the exact same value. Nothing to worry about. Just substitute it in the formula and you will get it. Okay. Now let's see how do you basically interpret the OBV indicator or the on balance volume indicator. So if the price direction is up and the OBV direction is up, then there is an uptrend. Whereas if the price direction is up but OBV is sideways, then that means that there is a moderate uptrend. If the price direction is up and the OBV direction is down, then there is a weak uptrend, right? And the uptrend is going to go down. If the price is sideways but the OBV is up, that means that a bottom has been created and an accumulation has been started. Whereas if the market is sideways and the OBV is also sideways, then we have nothing to interpret. We don't know what's happening. If the price is sideways and the OBV is down, that means that there is a distribution period. That means that is basically going to be the top of the trend. If the price is going down and the OBV is going up, then that means that weak downtrend near reversal. Okay. And if the price is going down and the OBV is sideways, then that means that there is a moderate down. If the price is also going down and the volume is also going down, then that means that there is a clear downtrend. Look at the indicator. If you look at this plate, wait, let me just use a pen. Price is going down, OBV is also going down. What does that mean? That means that there is a clear downtrend. Okay. Okay. Let's move on. Okay, now let's discuss what is given in the figure 9.2. Before that, let's read what they are saying, okay? In figure 9.2, the OBV is plotted along with the volume at the bottom of the GE chart, covering December 2010 to April 11. The pattern of OBV is similar to the pattern of the prices in the top panel, even though it created from volume. The primary difference between the price chart and the OBV line is that the peak in the center is flattering and the OBV does not decline as far. The divergence in the center of the chart, prices moving higher than OBV, would be interpreted as a divergence in which the price will stop rising. Now let's look at it. OBV is rising, price is rising. OBV is rising, price is sideways. Oh, sorry. Just a second. I got confused. Yeah. Price is rising, OBV is rising. Price is still rising here. OBV has become sideways. Price is falling, OBV is falling. Price is rising, OBV is rising. Now, do you see how in this particular area there was a divergence which gave an early signal to the market? Okay. Substituting the OBV for price in a moving average. If the OBV systematically improves, then we can use the OBV instead of the price to find trend signals. In figure 9.3, the S&P E-mini prices are shown in the top with a 40-day moving average. The moving average which is plotted in this diagram is a 40-day moving average, and the volume OBV and a 40-day moving average of the OBV is given in the panel. So here this is just the OBV, and this line over here is a 40 period moving average. This moving average is not of the price, this moving average is of the OBV values itself. So this is a volume moving average. Okay. The corresponding moving average trend lines are equally smooth but slightly different on the far right, where the prices rise soon than the OBV. Far right side, so this is the right side, the moving average is still sideways, whereas you can see that the price rose. It would be necessary to do a comprehensive test on many markets to find if the OBV produce better results than simply using the price. Okay. We know that the S&P and stocks in general are not the best choice for trending, therefore tests of interest rates would be more interesting. Volume indicators that combine the price move with the volume are additional possibilities. Okay. So until now, the three indicators which we saw using the volume, they were basically only taking volume into account and they were not considering price into account. Now the indicators which we'll be seeing are basically going to take price also into account. Before that, let's quickly see the formulas of whatever we saw until now. We saw what is a mm, okay. We saw how to basically normalize the volume, and then we saw what is a volume momentum. Volume momentum is today's volume minus the volume of that day. And if you want to find the percentage, it is today's volume minus volume of that day divided by volume of that day. What is force index? Force index is difference of the price, which is today's close minus that day's close multiplied by volume. Today's close minus yesterday's close multiplied by volume. Price change is always on today and the previous day. That is force index. Volume oscillator is going to give you volume divided by 14 minus the volume divided by 34, and then you are going to take the ratio of the same. Then we have on balance volume, where you are going to have, if the price is more than yesterday's price, then OBV is going to be price plus today's volume, OBV plus today's volume. And if today's price is less than yesterday, then today's OBV is going to be yesterday's OBV minus today's volume. And then yeah, okay, that's the basic stuff which you need to keep in mind for the from the purpose of examination. Okay, now let's come to the indicators which use price also in their calculations. So the first thing is the money flow index, which is also known as MFI. MFI is again just another type to use the OBV only. So I'll just quickly show you the money flow index. Money flow index. Okay, see, the money flow index also looks like this. I know you might be wondering that why do all of these indicators look just the same, but the only thing is they're all plotted the same way. They're all plotted in the form of in a form of a line chart, but they all have various methodologies and various different types of calculation as to why they are being used. Okay, so this is another variation of on balance volume, and it uses the average of high, low, and closing prices instead of just the closing prices. Until now, the indicators which we saw, they were using just the closing prices, but the money flow index uses the high, low instead of just the close. It is called as the money flow index, and it has been compared to RSI. Why has it been compared by RSI? Because like you saw on TradingView, it also has overbought, oversold, and everything. So it's quite similar to RSI. Okay. So TPT is equal to high plus low plus close divided by 3. High of the day, low of the day plus close divided by 3. And if today's TP is more than yesterday's TP, then money flow is going to be yesterday's plus TP multiplied by 2. Okay, don't worry about this calculation. Just look at it. Just look at it. TP more than yesterday's TP. Then what is the money flow index? Yesterday's money flow index plus today's TP multiplied by volume. Simple. If TP is less than yesterday, then today's money flow index is going to be yesterday's money flow index plus the TP multiplied by PT. Again, here there is a mistake. Let me correct it. If this is on your book also, make sure that you correct the mistake. If TP is less, then it's going to be minus of TPT, not plus. Plus is going to be if the TP is more than the yesterday's TP. If TP is less than yesterday's TP, then it's going to be money flow of yesterday minus of TP minus P. Keep that in mind. Okay. Then we have MFI, which is going to be 100 minus 100 upon 1 upon yesterday upon 1 upon MFM. Don't worry about it. You just need to know what is the money flow index. You don't have to worry about this. Okay. Now we have volume count indicator. What is a volume count indicator? Let's again try to plot that down. I don't think Trading View has it. Mm, whatever. I don't think this is what we're looking for. So let's just look at the book right now. Fine. So volume count indicator basically counts the volume. That's what the name also says. It also again resembles the OBV indicator. Is a running is a running total of the days when volume increases minus the days when the volume declines. So it is a total of the days when the volume increases minus the days when the volume decreases, right? And that is add 1 to cumulative value on the day when today's volume is greater than previous day. So whenever you have volume greater than the previous day, you are going to add 1 in that. Otherwise, if the opposite happens, then you are going to minus 1. Okay, so the volume count indicator or the VCI can be written as volume count indicator of yesterday plus today's volume minus yesterday's volume divided by modulus of today's volume minus yesterday's volume. Again, what is a volume count indicator? Volume count indicator talks about the running volume, which means the days in which the volume increased and the days in which the volume decreased. That is what is basically said whenever you are using this. Okay. Give me a second. Okay, try to read the formula and try to learn it. Yeah, just I'm pausing here for a second. Just try to read this entire page, then I'll continue. All right. Okay. So you know what a volume count indicator is, right? Yesterday's volume count minus of today's volume minus yesterday's volume divided by today's volume minus yesterday's volume. Very simple. Cool. Now let's talk about what is a volume accumulator. Let's see if this is available on TradingView. Volume accumulator. We have something like that, but it is not given by the original TradingView. See, this is the volume accumulator. Here you can see the volume was the highest, which means there was an accumulation taken. What happened after that? There was a big bull run, right? If you would have just entered by looking at this volume accumulation over here at 1660, then look at this. You could have increased 1786, right? So more than 150 rupees profit by just buying one share. So yeah, that's how powerful these indicators really are. A variation of Granville's OBV system is Mark Chaikin's volume accumulator. Instead of assigning all volume to either buyers or sellers, the volume accumulator uses a proportional volume corresponding to the relationship of the closing price to the intraday mean price. So the intraday mean is also taken into account and the closing price is taken into account, because they don't want to just say that one particular thing. They don't want to just say that the entire volume only depicts the buyers or the entire volume only depicts the sellers. They want to basically take into account both the volumes which belong to buying as well as the volumes which belong to the sellings. Okay, so the intraday mean price is also taken into account. If prices close at a high or low of the day, all volume is given to buyers or sellers in the OBV, right? In the OBV, what did we see? All the volume is either given to the buyers or all the volume is either given to the sellers, right? But If the close is at a mid range, then there is no volume that is added. So that is what can be accomplished when you're using a volume accumulator. Volume accumulator is yesterday's volume accumulator plus close minus low divided by high minus low multiplied by 0.50 multiplied by 2 multiplied by Vt. Really complex formulas, but I know. But you see, you don't have to by heart it, but you need to just understand the indicator so that even if it gets tested into in the question in the exam, you can look at the options and you'll be able to take at the correct volume. Now, how are you going to identify that this is the correct volume? The moment you think about volume accumulator, you need to just remember that, oh, volume accumulator is different as compared to the on balance volume. Why? Because it takes the intraday mean into account. The volume accumulator takes the intraday mean into account, and OBV was only looking at the high and low, was only looking at the closing prices. So the moment you see this high and low, close minus low 0.50, you saw that the range is also now in the picture. Since the range is also there, it cannot be OBV, right? So now I know that this is the formula of a volume accumulator. That's the way you're supposed to learn the formulas. You need to learn the formulas in such a way that you will be able to answer the MCQs. Okay. Now let's talk about what is an accumulation distribution. You might know what is AD, but I'll still show you if there's an. Okay. We have AD, which is accumulation and distribution. Look at this. This is how the graph looks like. This signifies accumulation areas and distribution areas. Look at here. Here the distribution peaked, and from there on we had a crazy, crazy fall. So that's how powerful these indicators really are. Here also you look. Just a second, my trading view isn't working. Yeah, here you can see it literally opened this high, and then there was a lower high created, and then there was a downfall from there on. So that's how powerful these indicators really are. Now let's see what how does this AD indicator work. Similar to the volume accumulator and also developed by Mark Shekin, the accumulation distribution indicator as well as intraday intensity, the price and volume trend and positive and negative volume indexes use a concept that relates to the buying and selling pressure. This compares the strength of the close compared to the open divided by the trading range. It is also called the money flow in some references. AD. Okay, in the following formula, the previous close can be substituted for the open if the opening price is not available. Accumulation distribution of today is yesterday plus the closing minus open divided by high minus low multiplied by the volume. Very simple. See, one thing which is common in all of these formulas is here they are always multiplying it with volume. Why? Because we're literally looking at the volume indicators. If they are not multiplying it by volume, then what's the point? We are literally studying the volume indicators. So yesterday's AD plus close minus open divided by high minus low divided by the range. Close minus open divided by the high minus range multiplied by volume. That is the accumulation distribution. Cool. We covered quite some indicators. Let's see more. Intraday intensity. This is also given by check-in only. Until now, we've been seeing so many indicators which is given by check-in. Now we are talking about what is an intraday intensity. Let me see if TradingView also allows me to show that. Intraday intensity. Mm. Okay, these are created by other creators. It's not created by TradingView itself. So I'm not able to open this. Now I'm not able to open this. Okay, never mind. Let's just see what the book has to offer. Okay, so intraday intensity uses the distribution of daily trading range to create a new indicator. If the intraday low is further from the close than the intraday high, in other words, prices nearer to high, then the indicator increases in value. Read that again. If the intraday low is further from the close than the intraday high, if the low is far from the close as compared to the high, then in that case the indicator will increase in value. Clear? So in this indicator, we basically need that the low is quite far, but the high is near the closing price. Okay, intraday intensity is yesterday's intensity plus close minus low minus high minus close divided by high and low. Okay, by just looking at this formula, what do you understand? You can see that from close you are taking out the low price and you're subtracting high from the close. So, oh, you can just see and you can identify that, okay, so they want the high, they're talking about high and low, and they're also dividing it by the range. But then they are using two brackets here and they are saying II, which is intraday intensity. You know that much. And in intraday intensity, we already studied that they are going to see that the high is closer as compared to the low. So high is closer as compared to the low. So the moment you see this, you know that you are talking about intraday intensity. So that's the way you are supposed to approach these formulas and not just get really scared by just looking at the formulas. Okay. Price and volume trend. The positive volume index and the negative volume index. Let's first see what is the price and volume trend, PVT. PVT applies volume to the daily percentage price change, which can be positive or negative. Note that this cannot be used for back adjusted futures prices, and so it is only used in the stock market. So, price and volume trend of today is yesterday's price and volume. This is so standard in all the volume indicators. You're going to take off yesterday and you're going to multiply it by the volume overall. You just have to see what is there on the inside. So here what we're going to do is closing price of today divided by closing price of yesterday minus 1. So that is going to give the volume. Closing price of today divided by closing price of yesterday minus 1. The moment you see that, you know you are talking about the price and volume trend. Now let's talk about the two variations on the positive volume index and the negative volume index. Both take the approach that a single indicator that adds and subtracts volume based on market direction is not informative. So in the first variation, the direction of the closing price determines whether the volume is added to the positive or the negative index. In the second variation, higher or lower volume compared to the previous day is the basis. Okay. So the first variation is the close is the determining factor. Close of today is more than close of yesterday, then the price volume indicator will be yesterday plus volume. Whereas if today's close is less than yesterday's close, then the negative volume indicator will be yesterday's negative volume and you are going to add the plus VT. Why are you adding here? Because you're anyway taking it to negative, right? If it was positive, then you would have minus, but you need more of the negative volume, so you are adding here. That is why in both the formulas you can see add. Hope you understood what I'm saying. Here you are anyway calculating negative, that's why you're not minusing it. In OBV and everything we were minusing, but we were subtracting it because we weren't taking only the negative into account, we were taking both the positive as well as negative into account. That is the first way of determining. And the second way of determining is, one second. The second way of determining is when the volume is more than yesterday's volume, then the positive is going to be positive value of yesterday plus CT upon CT minus 1. Okay, this is the second variation in which they are using volume instead of the closing price with the same formula, which is closing upon yesterday's closing. Simple stuff. Don't worry when you look at so many formulas. If you just go through this video 3 times, 4 times, you're literally going to be good to go for the exam. In Norman Fospak's stock market logic, the author studied stock trends from 1941 to 1975 based on variation 1. Variation 1 was according to the closing prices and concluded that if the PVI trend is up, there is a 79% that a bull market exists. If the PVI trend is down, then there is 67% that a bear market exists. If the negative volume index is up, then 96% that a bull market exists, and if the NVI trend is down, there is a 50% chance that a bear market exists. Now look at this. The negative volume trend is up. That means that the bull market is existing. This is a very contradicting thing which they said, but this is done and this is said by the author after so much of extensive research. So keep these in mind. If the PVI is up, then there's a good chance of bull market to exist. If the PVI trend is down, then there is a good chance that bear market is there. If the NVI is up, then there is a strong chance that a bull market exists. This is an opposite. And if the NVI is down, there is a 50% chance that the bear market exists.